Well, I appreciate everybody coming out today, and that was a very informative talk by Paul. There were some great questions: affordability, density, tax. So I really enjoyed it. I hope you guys did too. We're always trying to find something that we haven't done before and still kind of stay within our box, so to speak. And I think that's a big thing that the city is tackling. Code Next. I know anything's probably going to be better than what they have. It's at least as a developer builder, it's kind of a mess. But anyway, so for you guys that don't know, most of you do. My name is Robert Buchanan, CCG Capital. So I'm going to kind of go through some stuff here. Most of it's that you already know about, but just kind of rehash some stuff. This is our team. Myself, Robert Buchanan, Drew Buchanan, my wife, Allison Bruner, Director of Operations, Amin is our lending associate, Ryan Stewart, he was up front earlier, he's back out in the field, and then Tibet Stewart, Director of Marketing. So we've since our last meeting, Lunch and Learn back in the summer, we've added some people to it. After about 6 months or so, 9 months or so, I kind of seeing where we needed to add some people, some suggestions from some members, no names mentioned, but said that we were running too thin, and I agreed, but just had to figure out where we needed to add some people to. So we've added some people, and we're off and running. So one of the two funds we have, Pride of Austin High Yield Fund. It's our oldest, 2008 it was established. Regulation D security, filed in all 50 states. It's a LLC organized in Texas. And you investors are members. And K1s, targeting K1s March 15th. So I'm trying to get those out so you have a month to get it into Uncle Sam. But keep in mind, I'm not the tax accountant, so I'll let you know if there's going to be any update on that. 100% owned by investors. That is true. So that means we're not leveraged. We'll never leverage. We're never going to go out and get a line of credit from a bank. We're never going to, do any of that where if the end of the world comes in the banking industry, our line of credit's not pulled out from underneath us. 100% owned. So our duration, we established, like I said, in 2008. Great time. That was when the market crashed. But we survived, and here we are today. So 30 years, so it expires in 2028. We can do a 10-year extension, and majority of the members may extend beyond that. Terms are still the same as they've been, 9 to 18-month terms on loans, residential, commercial. We always build in extensions. Extensions cost the borrower 3 points for each extension. Our max, 70% LTV on residential, 65% on commercial, still the same. Our interest rates, 11 to 13, still the same there. Early on, some of you that were with us from the beginning, we were able to do 14% in 4 points, but now, for the last 3 years or so, we've been in this range. Our average is 12%. Always 3 lender discount points back to the fund. So, why should you be invested? Well, passive income. You invest in a pool, and the management team manages your money by making loans in real estate, first liens, deeds of trust. Cash flow versus equity, monthly, or I should say quarterly income through disbursements, or you can reinvest it. Equity, you put something in, you're not in a first lien position, could easily get wiped out. When is the end of that term with that project? Don't know. Be the bank. So we are the bank. We're like a private bank. Those who understand interest earn it. Those who don't, pay it. I don't know who, Tibet asked me who came up with that. Best I could come up with was David said it quite a bit, so I kind of took it from him, left it in there. But I think somebody else did.
British guy who built all the banks back in the 1600s, 1700s. I can't call his name.
Oh, is it Einstein? Einstein said it? Okay. 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 That's right. That's right. I remember now. So anyway, Einstein said it. He's French. So here we go. Sorry, I was a slide ahead. So why are bars seeking us out? Well, the conventional banks, still are not lending, and when they are lending, they're very tight with what they're lending on. They're not doing a lot of construction, development type loans. So that's where we fit that niche. Private lenders, institutional lenders are rebuilding America. I asked Amin this question this morning. I said, is this still the 20-month inquiries? And from that, we get about 3 LOIs. LOIs, the 3 LOIs is on the high side. LOIs, letter of interest. So about 20 times a month, Amin will get a call or an email or some kind of discussion about pitching a deal. And from that, he'll come with me to a few of them. And then from that, we'll see what fits. If it meets our lending parameters off the initial scan of it, then we'll look at our portfolio and see if it's going to, how it blends with our current portfolio mix. And then if we want to pursue it, then we issue a letter of interest, and that goes out to the bar. So anywhere from 1 to 3 a month, perhaps, on the letter of interest. Why are we a good source for funds for bars? We're asset-based lender. So we're looking at the asset, putting value in the asset, where banks put more value on the bar than they do the asset. We're the opposite of that. Although we do look at the bar. We want to make sure they're not in bankruptcy and have judgments and lawsuits and that sort of thing. But it's asset-based lending. And one other thing is faster underwriting. As long as they can produce the documents to us, we can go through underwriting pretty quickly and then close. So the manager of the High Yield Fund is CCG Capital Group, LLC. Up until November, I believe, it's been Pride of Austin Capital Partners, LLC. And in November, we did a simple name change with the Secretary of State and informed the IRS. So as I was explaining to Gary right before, nothing changed with the operating agreements. Nothing changed with the operating agreements of the management company or the operating agreements between the high yield fund and the management company. Those remain the same. They haven't been changed. They cannot be changed without, I believe it's a vote of the members. So, but we just did a simple name change from Capital Partners to CCG Capital Group. So how does a manager compensated? 1% annually of the fund balance, that's the investor dollars that are secured, equity. And then 1% annually of the loan balance, and that's servicing the loans. And that's paid by the bars. So all of these two come out of the gross income of the fund, and then the net is dispersed to the investors. We retain 0 earnings at the end of the year. No performance bonuses, and the management company earns usually 1 to 2 points, usually 1 point on the origination of a loan for brokering the loan. That again is paid by the bar. So our underwriting, we set our lending parameters back early on, and we've maintained those. We've guarded those lending parameters. We set the bar. We do not adjust the bar depending on what loan request we get. If it goes over the bar, that's great. We'll move on to the next step. If it doesn't, then we tell the bar, this is why we're not interested in it. The asset, bar, financial stability, exit, strategy, and contractors. These are all very important components of the underwriting. The asset, we're looking at the asset, the current state of it, what's to be done to it, as built, then the borrower financial stability. Can the borrower carry the note, service the note each month by loan interest payments? The exit strategy does the exit strategy make sense? Do they have multiple exit strategies? Say one, one is a good exit strategy, but it's could be some problems, or maybe some problems that could arise from that. Changes in a code next plan. Do they have an alternative exit strategy? And then one of the most important of these four is the contractor. Who's performing the work? Because as a lender, when we're given a valuation on as built or to be built, this valuation, or we're putting all our eggs in a basket that this contractor can perform. And if this contractor cannot perform, then we have an issue on our hands. So underwriting the contractor, we underwrite just very like a local bank would. Want to see their financials, want to see their work in progress, want to see work completed, references, the whole 9 yards on them. Consistency. So consistency, going back to the lending parameters, we're consistent in our makeup, what we do. We don't change it. We're not reinventing the wheel each loan request or every loan. With a small staff, we don't have time to reinvent. We don't have time to learn a new way of doing it. So we've been committed to this way, and it's worked, and we'll continue doing it this way. Now, that's not to say we do not look at some changes that are going on and such like that. But we are continuing with what our foundation is, and we'll continue that. We never put out money just to make a loan, because if we continuously guard our lending parameters, we're not going to do that. And we've lived through that. We will not ever do that. So I'd rather send an email out to the investors and say, the yield is a little lower this quarter because this loan request did not get through underwriting. So I'd rather send that than say, I shouldn't have made this loan, but I did because I had all this money, and now we're in trouble. So I never want to do that. Consider investors first. So it kind of goes back to that. I'm an investor just like most of you in the room are an investor. So what goes into servicing a loan? Invoicing. So we invoice on a monthly basis, interest, late fees, inspections. Inspections are very, very critical, especially on to-be-built projects. You're going out and inspecting the work completed, what they're requesting to be to draw on. Want to make sure that they're in good compliance and past inspections with the governing municipality, the engineers, surveyors, things of that nature. So we always want to make sure that they're doing the right thing there. Down date, title, getting that updated. And on the construction loan, you advance some money initially at closing, and then each draw you're advancing more. So you do a down date just to update the title, and that's usually $50, and the borrower is responsible for that. That'll also show us if there's any liens that have popped up on the title. Value checks, we can, if we have, like in Houston, their economy is taking a nosedive with the oil, and if there's some projects down there, we haven't done any new loans down there, but if we had some that were sitting for a while, we could do some value checks to see how the value in today's standards, where it's at. If it drops below our LTV, then we need to get the borrower to pay down on the note, so we're in good standing with that. And then finally, communication. Constant communication with our borrowers, making sure that they are, know that we're right here with them, that we're checking on them, and that they're constantly moving forward to the finish line with what their loan request or what their loan is being built for. So we're constantly in communication with the borrowers. So how does a loan exit? The easiest way for a loan to exit, for us and them, is a payoff. They sell it or they refinance it and they pay us off. The next is an extension. Say they can't sell it. For example, a couple of loans in Houston, they've had trouble selling it, moving their product. It's slowed down. So they've done extensions to extend it out. They pay for the extension. And now some of those are cycling back off, are being paid off. We had one pay off Monday. We have another one paying off next Monday. So these are where extensions helps the borrower and also gives us some added income as well. Workout. So a workout solution is, they can exit, pay off. They're having trouble coming up with the funds for an extension. And then we're trying to work out a solution to this. Maybe, not charging an extension on them, but we'd rather them have a performing note and get to the finish line where they win and we win. Then we get into the foreclosure. As you know, we've had to foreclose on properties. That's the last thing we want to do, but we have to protect our asset, our investment. So we will foreclose, and then once we foreclose, we want to liquidate it because this fund is not set up to hold properties. It's set up as a lender, and if we have to foreclose, we want to liquidate it and get that capital working again. So here's our net yield. We sent this out to the investors. And this is our net yield over the past 3 years. So you can see we're kind of, the last 2 years, we're kind of in that high 10s, maybe low 11s. And I foresee that to be kind of our point going forward. I think it'll have a little bit of a upward tick when we get another REO or two off our books. And get that money working again. But, we've only ever had one quarter that was ever below double digits. So, and then here's our diversification of the portfolio. Remember, this is at 12/31/2015. So residential construction, just under the 25 million mark. The other big one is the commercial development and commercial construction. Since 12/31, we have closed on a almost $3.5 million commercial loan, so that will increase. And currently, we're underwriting a $4 million commercial construction loan in Cedar Park that's scheduled to close. Well, I shouldn't say scheduled. It's earmarked to close late next month. So hopefully that does come through, and that will also increase that. So that will get us, we won't be so heavy on the residential construction. The other ones, we have the non-performing, which I'll get into, real estate owned, I'll get into. Then we have our reserve account, our commercial income producing, cash on hand, and things of that nature, our reserve. I mentioned that earlier. So this is kind of our spread there of the assets in the portfolio. So here, the REO properties. In July when I talked, we had 4 properties. Since then, we've moved one of them, so we've come down in our. It was like a little over 7 million. Now we're at 6.4. We're 10% of the portfolio. 3 loans. There are 3 properties left. One of the properties is under contract, and it represents 2.6 million of this 6.4. So let's go into each one of these. So the first one is out in Lago Vista. It's the convenience store out there. It's listed for sale, and it's 65% leased. We have a small in-cap space that's not leased. The net lease income to the fund is roughly about $6,500 per month. The leases are in place are triple net, so all expenses are paid by the tenants, managed by Goodwin Properties.
It's a little shopping center.
Yes. Got a convenience store. Oski's is the convenience store, and Maria's Mexican is a restaurant, excuse me.
How much is listed for sale?
It's a little over $1 million. $1,050,000, I believe, is what it's listed for sale. In April, the Maria's lease is up, and we're going to go in and try to negotiate a higher lease with her, see if we can get that up a little bit. And but with the Oski's, right before, many of you may know, right before we foreclosed on it, the previous owner did a 5-year lease with the tenant Oski's with 3 5-year renewals at a pretty low rate. So we've been trying to find any late fees or anything that we can try to get them out of that lease, because we're kind of held hostage a little bit there. But we feel like myself and Jeff Bailey, who's marketing it, that we can get Maria's up a little bit more, and we get that in-cap space lease. It may be attractive to a buyer. But we're getting each quarter $20,000 income into the fund. So I mean, all's not lost. So.
Right, yeah, I was going to ask.
Yes, John.
What percent return does that make to the loan? Is it better than the 10 or 11 or 12%?
That's a good question. Let me. Six and a, well, a little more, about 7.5, I would say. It's about a 850 loan, somewhere in that. 8, maybe 7.5, 8%.
Okay.
So it's it's a little less, but it's still something.
It's not zero.
It's not zero. It's not negative. All expenses are paid. So
Who pays property tax?
Yep. Property taxes are paid by the tenants. Insurance is paid by the tenants. So, so when I say that, that's that's
Yeah,
net.
Are those 20-year leases up? Wow.
Yeah. Tell me about it. The next 2 are in Fulshire. Building 1, Building 2, down there, the same ones we've had. We're still under contract with the church for Building 2. Right now, we're going through, it's in with the city of Fulshire, planning and zoning for replat into 2 lots. So we're basically, it's 1 lot. Currently, it's 1 lot with 2 buildings. So we're hired a consultant to do the replat with the city. And so we're in the midst of that. We've had 2 rounds of comments from P&Z, and we're going back in. So hopefully we're looking at being approved next month, late next month, and then we can get on with closing.
So the contract with the church is contingent on success with the replat?
Yes.
And then spending?
Yes. Yeah. And our comments, couple of, in the first round of comments, there was a couple of items on there that kind of scared me, but the consultant said this is typical with basically any city, and so you go in, you kind of bend over for a couple of them, and then you fight on a couple of them, and so we've done that, and now it's just kind of dotting the I's, crossing the T's, and getting on with that. The building up front, Building 1, we have multiple tenants in that. We keep adding a tenant here and there, about 1 a quarter. I'd say it's 55% leased. So it's it's slowly becoming occupied. Obviously, we like to move it as well. So it's managed and marketed by Central Management. Trent Vosick is the CCIM broker down there on that. So really looking forward to trying to get this this building, this REO off, and that will get us down to 2, and then hopefully we keep moving forward, getting him off.
On building 1, where it's partially leased out, 50+%, what's the threshold of occupancy when it becomes attractive for an investor? I mean,
I would say close to that 100% mark.
well, yeah, I mean,
Yeah.
obviously, but I mean, is there,
You know, it really comes down. I mean, what they're paying and the cap. You know, what the cap they're looking for. John, what would you say would be aggressive? I mean, ideal for you on something like the
Like
commercial?
cap rate?
Yeah.
You know, I'm not too familiar with the area.
Well, just talk- just-
Culture, right?
yeah, just
They're
say
going
Austin.
In Austin, what, 6%?
Yeah.
Is what they're going, San Antonio, maybe 7. And so, I mean, these are new, I would consider for that area, Class A. So, you know, I'm not too familiar with
so it's
it.
not in an unattractive zone as far as occupancy rate, I guess is part of what I was trying to ask.
Yeah, I just think it's a smaller community from what I know. I've not
Yeah.
been out there in years and years, but.
It's smaller. It's growing. They're growing. It just, I think it was a little aggressive for the time, and hindsight, armchair quarterback. But you know, we'll keep on moving and get this one pushed off, and then keep working to get the other one occupied and make it attractive to an investor to buy. John?
Rob, so if, assuming closure on building 2.
Yes, sir.
Is that, how much does that pay off the loan? Is that?
They're two separate
Oh, they're
separate
two
loans.
separate ones.
Yeah, they're 2 separate loans. You got 2 loans for the 2 buildings.
And would that one break even?
We would without seeing a settlement statement, we would get a little bit of a return because I gave them my bottom line, like this is what the seller must net, and that was early on in our negotiation. So of course since then we pay property tax bill, but we should get we won't have we'll still have our shirts on our back and maybe some pocket change.
Right.
So.
And then the building 1, is that where the church is?
There's a little church in there, yes, yeah. And the church another church is buying under contract for building 2.
Oh, okay.
Yeah. Yeah, so.
Competitors? Oh, God, praise the Lord.
So we have one that moved into a non-performing since our last, and this is a 5.6 acre plus or minus tract of land, 12th and Hargraves in East Austin. It's in bankruptcy court with exit by Tuesday. We had a hearing on it a couple weeks ago to dismiss by March 1st. Right now we have a scheduled hearing for Monday. We are having a hearing on what the payoff is. We're saying that we're owed interest during the time it's been in bankruptcy court, and the debtor is saying that we're not. So we're kind of fighting over the, I guess, our income since November. Hopefully, that the hearing, the motion that I received, it said that they wanted to have the hearing between now and early Monday. It's scheduled for 9:30 Monday, so that whatever the court ruled, that we could have a closing on Monday afternoon. So that's the information I read last night in one of the motions. So that's where we are, and that would bring us in about a little over $4.5 million. So back in capital, which we already have it earmarked for our commercial project in Cedar Park, and so that's where we are with that non-performing. So I'll keep you updated as things move next week with it. I'll get Tibet and I will work together and inform you what's going on with that non-performing.
Rob, what percent of the REO does this real estate does this represent?
This, that non-performing is 9%.
And it's 9%
Of the whole portfolio.
Okay.
There's only one loan in non-performing.
Oh, okay.
So it's 9%. It was a $3.7 million loan roughly, and then you add in some. We've had to protect ourselves, make the property tax payments, and then interest and stuff. So they're saying the payoff is 4.2 and change, and we're saying it's closer to 4.6. So we'll see where the dust settles.
Do you have any sense that they'll be able to pay that Monday or Tuesday?
They say they can. They say they've secured funding from some well-known local private lenders.
So, would it be correct to say that those three are all in the commercial reg?
The three REOs?
Yeah.
Yes, they are.
Does that tell you anything about that market or
Um,
what's happening?
Well, it tells me that with the sorry, where am I going? This one here, commercial out in Lago Vista. This was an existing that we did as an umbrella. So this is the last of 4 properties that we refinanced from a bank. Guy was looking at foreclosure about 3 years ago, and so it was more of a portfolio type loan. So would I go and do a commercial loan in Lago Vista? No. So that, did I learn something from that? Yeah.
Nothing generally about the commercial market versus residential or
Not really. There's commercial demand in Austin. It's, the outlying areas, there's a big demand for it. Were we aggressive in the Fulcher? Probably so. But when you look at the appraisal and you look at the growth and stuff, and you drive down the street and you see neighborhoods being built, it shows that they need small office, and so we thought we were filling a niche there. And then when you have a borrower that basically commits fraud, it's and has fake leases drawn up to show that it's pre-leased, it's kind of hard. And you actually meet these supposedly tenants on site at the construction project. It's kind of hard. It's kind of hard. So did I learn something? Yeah, I kind of learned something.
That was my question. What'd you learn?
I learned not to take pre-leases. So we'll never do anything on pre-lease.
Good.
So it was an Australian guy, and he had a group of investors back. No offense. I'm just saying it was an international, and there were a couple of his investors back there called, emailed me a few times, and they were out quite a bit of money, and so it was kind of sad to hear their story, and anyway, so we did learn a lesson about that. But commercial, I think commercial is growing, and there's a need for it. When you have 110 people moving to Central Texas, they need. Paul said Dove Springs. They need medical buildings. They need grocery stores. They need that. So, we need to find somebody out that needs to do something in Dove Springs.
Got it. Get on it.
So activity, what have we done the last 6 months? We've done a lot. But what has the fund done in the last 6 months? We sold one of the REO properties. We've done a couple of loans in North Carolina. We're taking advantage of a hot market out there in the Raleigh-Durham area. In the Charlotte area, there's a lot of growth there. Raleigh-Durham's a tech hub, kind of like Austin right there, and there's a lot of growth there. And so we're taking advantage of that. There's a group that I've become to know over the past 6 or 7 years through AAPL, our organization. Blue Hill, and good guys, and they got a great team together out there, a little larger than our team, and they've got 2 offices, one in Raleigh-Durham, one in Charlotte, and they're knocking it out of the park out there. And I go back out there next week to visit with them, leg brace and all, and to see what the status on on the loans we have, and also check on do a site visit for something that we're going to underwrite coming up very soon. I mentioned the underwriting $4 million commercial loan in Cedar Park. This is right behind the Costco in Cedar Park. This is a multi-use facility, 2 buildings. This is a group out of Utah that does not mixed use. Does their model is event center, and so they lease it out. They rent out the space. And I've gone to see a couple of their locations in California, Sacramento area, and I went to their home office in Utah, Salt Lake City, in January to see a grand opening of one of their facilities there and meet the whole their administrative team. So we are, and the local contractor, the contractor, the GC is a local contractor here in Austin, Fine Line Construction. So we're doing our due diligence on the contractor. So that's coming up fairly soon. We're hoping that we can get that in this quarter. And then on the lawsuit update, just wanted to update you on the lawsuit that involves the management company and what the kind of still in the same place we've been for a while. Depositions, a few more depositions have been taken. Mine as a fact witness, the attorney that drew up all the documents, Bruce Hardesty, his deposition was taken. And now our legal team is trying to schedule deposition of the plaintiff. We're hoping to get that done next month. So, right, and that's basically it.
These were sworn depositions?
Yeah, oh yeah, yeah.
Isn't that difficult to do, get an attorney under oath? Everybody in the courtroom has to swear up there, never these earnings. You ever never noticed that?
And that lawsuit is regarding that one property that already.
No, it has nothing to do with anything in the fund at all. It was it's a lawsuit that goes back to a transaction that Capital Partners was hired to underwrite, and we advised the plaintiff not to do it. She did it anyway, and it went bad. Now she's suing. But I just, want to, transparency, full disclosure, just to update everybody on what's going on with that.
What's at stake in it?
She received some money back, like half, a little over $1 million when they sold the equipment. It was a printing company, and so she was out roughly $1 million, and that's what she's seeking.
What grounds? I don't want to take too much time.
No, it's fine. Grounds are that she's a poor old lady and she was taken advantage of. Basically, if you want, I got the petitions. I don't mind sending it. If anybody wants a petition, I can send it. Gary, I've sent it to Gary. I've sent it to quite a few of you, but anybody wants it, I mean.
Well, I'm curious, so how many, like in the last few years, how many loans have you done outside of Texas? I wasn't aware that this fund did a lot of activity outside of Texas.
We've done now. We're working. We've about to start underwriting, I believe, our fifth loan.
Okay.
So, in our PPM, it states that we are 80%, I believe, in Texas. And that's kind of a model. And that we still hit that.
And when you decided to do a loan outside of Texas, you mentioned this other group in North Carolina. Is that like some kind of a sister-related group to Pride of Boston, is it called Pride of Carolina? Or?
No, it has no relationship other than a relationship was established through AAPL about 6-7 years. AAPL, American Association of Private Lenders.
Okay.
We're one of the founding members of that, and Bill Worsley, I almost said Bill Dodd, but Bill Worsley and Kyle Groves out there. I've known those guys for a while.
So they're in the same business as you guys, and so
Well, no, they're not lenders, they're developers.
oh,
So we're lending to them, they're developing.
okay,
They have a staff of about 7 or 8 people, experienced people.
okay.
Bill heads up the Charlotte office,
Okay.
Kyle heads up the Raleigh-Durham.
Okay.
So let me just be clear. When I say we're doing some stuff outside of Texas, we're not just going out soliciting somebody to come in. This is a kind of a unique situation. There's a relationships already started there, been there for a while, and so there's a trust already built there. And of course, we still do our same underwriting. I've been out there probably 7 or 8 times in the last year. I'm going out there again. So we still could put the same attention on it as we do anything else.
Well, I had seen the earlier slide where you said it was registered in 50 states. I thought, okay, this is like a satellite office in the Carolinas that's lending out money. And it's a developer out there that had a previous relationship with AAPL. Okay, now I get it. Thanks.
Yeah. Now, when you say registered in 50 states, that means we're allowed to take investors from all 50 states.
Okay.
Ron,
Yes, Barbara.
you're saying underwriting a $4 billion commercial loan in Cedar Park?
Yes, ma'am.
So how much is that? What are we doing?
What do we?
Are we gonna loan them $4 million, or is it?
Well, that's
The third bullet?
Yeah. We are in the middle of underwriting a $4 million loan request for a commercial building in Cedar Park. It's roughly 27,000 square feet, kind of a and B type event center, right behind the Costco. And so we're under.
It's not to a loan stage yet, it's just.
Right. No, we have not done a loan commitment or anything like that. So we're looking at I was looking at the contract this morning, the contract between the GC and the owner, and things of that nature. So we're still in the midst of underwriting. We have
Is that a construction deal? Or
it would be a
is
construction. Yep, ground up construction. Sure. What? Any other questions on this so Pride of Boston Opportunity Fund is our second fund, established summer of 14. Kind of the same thing as I went through earlier, May of 14. It still has a 30-year as the high yield fund. Accredited investors only. The minimum is $50,000, 2-year term. This one is a semi-annual distribution, whereas the high yield fund is a quarterly, and then you can reinvest or take. On this one, it's twice a year, and the money is pushed out to the investors. The distribution is 100%, again, 100% owned by the investors. Second liens are permitted on this one, provided first lien is held by the high yield fund. And this was kind of one of the basis that this was established, was to allow us to do some loans that were in the low 70% LTV that we were losing out on, that the high yield fund couldn't do because it has a threshold. Whereas the Opportunity Fund can go up to 80% collectively. So if the high yield fund takes the first 65%, then Opportunity can only produce 15% or less. And it's the second if it's involved. And it won't do a second without the high yield fund, because then you don't have no control over it. If they default and we're in a second and Wells Fargo's in a first, we have to pay off Wells Fargo or we lose out, and we don't want to do that. Yes, sir.
I assume the high yield fund is not closed out for more investors?
No, it's open.
And what is the minimum of that?
50,000 on that one.
Okay.
They're both 50.
And 2-year commitment?
2-year commitment on that as well.
And that one's quarterly payouts?
Yes, sir, quarterly.
Okay.
Yes, opportunity, semi-annual, right?
Yes,
So
semi-annual.
it's
Yep, semi-annual. This one can go up to 5 years too, so we can go up to a term of 5 years. But we're only doing a 5-year if it's the first lien. So net yield to investors, this is kind of and the reason why it's this way is it recognizes income. Both funds recognize income when it's earned, cash basis accounting. So an opportunity fund, it does not receive interest on a monthly basis like the high yield fund. It receives interest when a loan matures. So when we made our first loan in the first 6 months, we only received the origination fee, the points, 3 points. So that was our little return. And then June of last year, we had our first loan pay off, and we made a couple of more loans, so it spiked because we recognized the interest, and we also got an exit fee. So that's the opportunity. Usually we get 2 points on the exit of the loan balance. And then during this 6 months, we did not have a loan exit, but we did make some loans, and that's what we were able to bring in. So this next 6 months, we're going to have a couple of them pay off, and it will go back up. So over time, I think, we won't get back down to this, hopefully, and these two will get closer together once you start cycling through loans and originating newer loans.
It's really faint. Could you say what those numbers are?
Oh yeah, 6.1, 13.1, 9.6. And here's a breakup of this. This just has about 7 million, whereas the high yield fund had a little over 64 million. So collectively, we're north of 70 million in assets that we're managing. And this is when I give you this amount, that's the appraised value. So residential new construction, that's when I put it like that, that is for the acquisition, helping the acquisition, because it does not do construction. It just provides a bridge type financing or help with acquisition of a property. Residential rehab, so it helped with securing that property. And then residential land development, that's again securing the land so that the development of the residential development can take place. That's all I got. Questions?
Yeah. So, as an investor, why would I do the opportunity? What's the benefit to putting the money there rather than
Benefit. It's
risk.
risk are a little high. Can be higher. Subject to be higher. You got a higher LTV, and you could be in a second in some cases. I think the reward at the end it could be a little higher too. I think you're going to see distributions in that 12-14% once we get some more volume going on that fund. If you like the quarterly steady kind of eddy that's been, because it's been, you got to think the high yield fund's 8 years, 9 years now, and it's kind of got that proven quarterly 10-11%. And if you're just, like that model, that's the model for you. But if you want to diversify a little bit and like, a potential to earn more than that, then Opportunity Fund could be. But it could, keep in mind, it may be a little bit of a roller coaster on that.
Ron, do I recall correctly that the Opportunity Fund also has an equity stake in the projects?
No, it did on our first loan, and I was advised by a couple of attorneys that when you're a lender, you don't want to really do that, because then if they do an account, say an expense hits it, and you question that expense, well then you're not really the lender anymore. You're kind of telling them how to operate their business, and you got to be careful. So that was a one and done on that. I'd rather be, safe and just not tell them how to do their business and get an exit fee.
So then the risk reward and the opportunity is the exit points Is the difference loan terms a little longer, rates about the same, points up front, at the
Yeah.
back end?
Back end, typically 2 points on the back end. The interest, the interest may be, the interest is typically 10%. So you're getting 3, 10, and potentially 2.
The borrower pays fees on the exit of the loan?
Yes, 2 points on the exit. Kind of similar to an origination, but just on the back
Of the remaining balance.
of the balance of the note.
And up front, he's paying 3 points.
3 points.
So the risk is the second lien position, right?
Correct.
Gotcha.
And a little higher LTV. So say
Right.
we were in a second, and the high yield fund and opportunity fund collectively were at 77%,
Right.
and you sold it for 75%. Well, high yield fund's going to get it because they're in the first, and then
And it's only gonna be second to the yield fund.
correct, only second to it. Otherwise, we won't take a look at it. Yes, Barbara.
On the new website,
Yes, ma'am.
Been there, I just saw that,
Yeah.
there's a new website.
are all the loans listed?
No, ma'am.
No.
No. We've never listed our loans on the website. So
So is there any way to
see
see?
loan. I mean, I can send you loans if you like. Yeah,
No, I just want the addresses. I don't want to know all the
sure. We can make up a list of.
details. Okay, thanks.
You're right. So
Shifting gears a little bit.
yes,
Do we still have a board of directors?
board of directors. Yes, we still have a
Okay,
board.
It's not on the website anymore, and it used to be.
Well, board of directors. Yeah, it's in the PPM. It's in there. I think it's an operating agreement too. So we still have a board of directors.
Used to be able to go on the website and see
Right.
everybody.
Have we ever had a board of directors meeting? No. So I mean,
Still are hanging around. Okay.
but I want to add before I forget, I do have Eric Lusk in the audience. Eric has been with me, since the beginning of Capital Partners. He's a member of Capital Partners. Lives out in the Midland, Odessa, Big Spring, and he's here. So anyway, it's not just me. So so I have Eric, Michael, and Janice Kovich. There's 4 members of the management company of the LLC. So we're the ones, that you get together and talk and lawsuit or this, the hard issues. That's where it's not. It's a member. I'm the managing member, but Eric and Michael and Janice are members as well. So, Jim.
On the hard rate deal, what's the underlying issues? Why hasn't the developer been able to accomplish their goals?
The city of Austin wanted him to put a road through the middle of his development, and he didn't want to do that, and he just he hit a wall and just kind of stood there.
So time got standstill.
Yeah, and I had a guy, his partner emailed me Monday and Tuesday saying wanted to buy it, and he had an investor lined up to buy it, and I'm like, well, you got, I'm just a lender. I can't sell you something I don't own. So, I mean, 5.6 acres in Austin. I mean, there's people out there who would buy it. Why he, didn't move forward, I don't know. It's kind of strange, but Yeah, Eric.
Rob, do you know about how many active loans there are in each fund?
Active loans in the Opportunity Fund. There's probably 7 or 8 active loans. 6 or 7, I would say. And in the High Yield Fund, there is. I had it. $49 minus the REO, the 3 REOs and the MP, so what, 45? 45 active loans. 49 minus 4, 45. 4, yeah. You got the non-performing and the 3 REOs. So 45 and 6, so about 50 active loans.
I had the same question about the number of investors in each fund. The number of investors in each fund. Right?
Number of investors, high yield funds, 200 plus, opportunity funds, probably 14, 15.
Okay.
Yeah.
For the Opportunity Fund, do you anticipate as it, I'll call it mature, going sort of stability, where the high yield is sort of getting to
Mhm.
that? Do you anticipate the same number of loans there?
No, I don't. I don't want to add more and more people to the staff to help. So
You're just gonna keep it throttled?
it'll yeah. I mean, it's just little increments here and there, but it's not going to get anywhere near that 60. I mean, maybe 20, 25, 30. We'll see. But yeah, we're comfortable where we are. We don't want to. We're not chasing anything down the street. I think we have a proven model, and we'll just continue building on that proven model. And
Is there a cap on how many loans you can have? I'm back to the
No, no.
high yield fund.
no cap, no cap. The only cap you have is it's $100 million. So I can raise $100 million from investors, and that could be any number of loans. Now, I don't want any number of loans. I think we're comfortable in that we've had as many as 53, 54 loans in the high yield fund, and that's comfortable for us. So we're not. It's not quantity; it's quality. So. All right. Well, that's all. I appreciate everybody coming, and
Yes.
enjoy the rest of your day. Thank you.